tiny delay. And also once my screen is maximized, again, I won't be able to see. It says setting up your Facebook Live. I should be live in a moment. Done. Okay. Hi, everybody. This is Leticia coming to you this beautiful Thursday afternoon. And we are doing today my recently announced Money Matters webinar. Today is our third session, and the topic of today's conversation is Robo-Advisors, the new digital age of investing. And I have a guest with me today, Neil. I will introduce him to you shortly. In order to give some context to today's conversation, I figured I would share a few slides that I prepared for you. Okay, I will go ahead. Okay, so in my first webinar, we discussed a concept called the financial planning pyramid, and that is how you can think of your financial planning or your financial life as your financial offenses, which are different types of investments, anything that moves you forward financially, and then your financial defenses, which are insurance products, anything that you can put in place as a stop loss to prevent financial losses and other types of losses in your life. So today we're going to be focusing on the wealth accumulation, financial offenses portion of the conversation, specifically the area what we term here building net worth. Okay. Now, as you can see in this financial planning pyramid, in other conversations, we will get into other types of investments, such as real estate investing and even more exotic things. But today's topic, as we discussed, is the idea of robo-advisors. So if we look at the Canadian investing marketplace, according to the 2017 census, which was like the most recent one done on this topic, 65% of Canadians are saving for retirement. And most of the money is going into registered investment vehicles, what people refer to as RRSPs, registered retirement savings plans, and TFSAs. Now, I'm not going to go deeply into the differences between those two on this call, but the idea is that these are preferred investment vehicles. They are tax sheltered investment vehicles. And okay, I'm drawing a blank right now. As opposed to something known as a non-registered investment, where your money would get taxed every single year. Okay, and in terms of RRSPs alone, BMO did a survey, and they do an annual survey of their clients. And what they found was that the average money held in Canadian RRSPs is just over 100K. And again, RRSPs tend to be the preferred savings and investment vehicle for Canadians. Now, you may wonder, well, okay, and by the way, a lot of Canadians don't understand what even is an RRSP, what is a TFSA, what are these things? And the best way to think of it is like an envelope. And in that envelope, you're allowed to hold a certain type of investments. And specifically, the investments that you're allowed to hold inside an RRSP or a TFSA, inside one of these registered investment vehicles, are known as qualified investments. So here's a list of what the government will allow you to hold. Okay, cash is one of the things. Gold and silver bullions, that's something a lot of people don't know about, and I do plan on discussing that on a future call. Stocks and bonds, ETFs, and we will discuss that on today's call. Mutual funds, even though it's listed last. In case you're wondering, where do you think most Canadians are putting their RRSP investments? And I'm willing to bet that most people are putting their money in mutual funds. Most Canadians would go to their bank and they are offered a portfolio of mutual funds or different mutual funds to choose from. And again, what a mutual fund is an envelope in which you may have a variety of stocks and bonds. Now, what a lot of people don't realize is that there's a cost for putting your money in mutual funds. And the average cost, also known as a management expense ratio, is 2.5% for Canadian mutual funds. So what happens is those fees that the bank takes, whether or not you make money, the bank will take those fees up front. Those in time eat up from your own wealth that you would be building for yourself. Thus, in time, you're actually forfeiting some of your own wealth. So that's part of the reason for today's conversation. And before I pass on the control to Neil, I will just go ahead and read Neil's bio. Give me 1 second. Okay. Okay. So, Neil Greenbaum has a long background in the financial services industry, having spent the first 19 years of his career at a top-tier mutual fund company. From operations to client services, from training to development to sales, Neil provided excellent leadership and always delivered with the intended results. Recognizing the importance of new trends in the financial industry, Neil joined NestWealth, where for the past few years, he has been helping advisors like myself modernize our businesses and improve the client experience. Neil delivers large-scale seminars on a regular basis to advisor and industry conferences, and I'm grateful that he has taken a bit of time to join us today to speak about how robo-advisors are changing the investing landscape. And so everyone, please help me welcome Neil.
Thank you.
Okay. So Neil, I know you wanted me to start our conversation by sharing a video that you think is a good introduction to this topic. So I'm just going to bring that up for our audience.
Okay.
Okay. And by the way, everyone, I'm not able to see if there are any questions on the screen. I will check, we will both check questions at the end. And if there are any questions, we'll be happy to answer them. Okay. Neil, right here. Okay. Before I do that, I'm going to have to share my computer sounds. Share computer sounds. I learned that lesson last time. Okay, full screen. Okay. Hold on, I actually have to do a new share and share my screen. There it is. Okay, and I will put.
Or seeing their commercials on TV. They're not really robots. They're software platforms that manage your investments powered by algorithms, but made by humans, really smart humans. Accounts managed by robo-advisors require less money to start and offer lower cost investment products. They customize your portfolios by examining your personal data and your investment goals. Online investment advice was born in the late 1990s, but robo-advisors really sprung on the scene in 2010, a couple of years after the 2008 recession. There are now more than 200 of them, managing over $70 billion. That may sound impressive, but it's not a lot considering the $32 trillion of investable assets currently in the United States. But time is on robo-advisor's side, and it's all thanks to demographics. Baby boomers and their parents, the silent generation, currently make up about 1/3 of the U.S. population. However, they control about 83% of U.S. net wealth. These generations have mostly relied on human investing professionals and financial advisors to help them decide what to do with all that money. But the financial advisory business is facing a transformational change. You see, those 83 million boomers and older folks who control so much wealth, they'll peak as the wealthiest demographic in the next 15 years. Generation X will become the wealthiest demographic, amassing $37 trillion by 2030. Millennials will have about $20 trillion by then. But these younger generations may be less likely to use financial advisors and invest like their parents and grandparents. A lot of them lost trust in the financial system after the 2008 recession, and many don't see why they should pay another person to manage their money when technology can do it cheaper and with more accuracy. That's a real threat to human financial advisors who are already facing their clients getting older with younger generations less inclined to hire them. In fact, 66% of children fire their parents' financial advisor after they receive an inheritance. Now, big investing firms have seen this coming, so they've been busy building or buying their own robo-advisor platforms, trying to catch this growing wave of younger digital investors. Studies say the robo-advisor, or the digital advice market as they call it, will swell to $500 billion by 2020. And traditional investing firms like Fidelity, Schwab, and Vanguard, they'll control 2/3 of all assets in that market, a huge chunk. Currently, the typical customer is between 35 and 45 years old, and has an average account balance between $20,000 and $100,000. That's a lot less money than financial advisors are used to managing. So, is there still a place for people in a digital advisor world? Well, probably, if they learn to use robo-technology as part of their services. You see, robo-advisors have yet to experience a true bear market. They haven't had panic clients watch their savings and investments circle the drain. That day will come, it always does, and the need for a real person with expertise on the other end of the phone will be there. But who or what will be on the other end of that line is the multi-trillion-dollar question facing investors, advisors, and money management companies around the world.
That's it. Is there more to that video, or that's it?
Nope, that was it.
That was it. Okay, good. So,
So
yeah.
perfect. Yeah.
Okay, and I know you have some slides of your own to share with us.
Exactly. So
okay, let me share that screen.
Perfect.
Okay.
So listen, I'm just going to start talking, and
absolutely,
because I think, listen, the video I think was important just because I think it had some interesting things for us to think about. Do I agree with everything that was said in that video? Absolutely not. But what I do agree with, or what I think is important to understand, is that you know, as much as there's technology, as much as there's this thing called robo-advisors, which we'll talk about, it doesn't replace the human. And that's the key message there, is that, you know, for all the technology that is available, you still need the expertise of a Letitia, of an advisor to walk you off the ledge, to make sure that you're doing the right things for the insurance side of your life, for the investing side of your life, for every part of your financial outlook. And really, and that's because that advisor has the confidence, the knowledge, the experience, the trust, and all those things that oftentimes advisors or clients won't do because they need that helping hand. They need that advisor to show them the way, to show them the path, and to make sure that there's someone looking out for them. Because again, investments and the whole financial thing can be confusing for most clients. They don't have the knowledge. They don't necessarily understand it all. Yes, you could do it yourself, but that's not really the best way. The best way is for advisors like Letitia to leverage the technology that is available. And that's why we're talking about NestWealth and Robo-Advisor, to leverage that technology so that she can do what she does and do it at the highest level possible.
No, thank you, Neil.
That's what it's all about. Really.
Thank you, Neil.
Yeah.
No, there are, in my experience, there are some people that are absolutely do-it-yourselfers. But what statistics have shown is that clients that do work with an advisor will have a higher net worth at the end of the day. Time and time again, studies have shown that working with an advisor ends up in just higher net worth at the end of the day. And so that being said, there are do-it-yourself platforms out there. Today, we're here to talk about, first of all, what is a robo-advisor and how you could potentially incorporate that into your own financial planning and investing practices. Should I move to the next slide?
Sure. So just yeah, you can. But what we want to do is basically there's a document that you see in front of you. This is just sort of a piece that I use. You can skip the table of contents. And basically, yeah, perfect, right here. So there is a lot of text that you'll see on these pages. I don't want you to focus on the text. Feel free to read it as I'm talking, for sure. But I'm basically going to summarize what's on the page so that you can understand it and give you some insights or at least my knowledge as it relates to this space. So again, I think the first thing we want to answer is, what the hell is a robo-advisor? I think there's a lot of misconceptions out there as to what a robo-advisor is. I want to dispel those, at least the myths, but I also want to give you clarity as to what exactly a robo is. First of all, I hate the name. I think anyone that is involved in this business, at least, you know, at the level I am, or advisors, or even firms, don't like the name robo-advisors because it implies that there is a robot, okay? That there is somehow that, you know, this is just all automated, that there's no human interaction, there's no human involvement. It is a terrible, terrible moniker or name for a service.
That video didn't help much with the little robots either.
I hear you, but I want you to understand that robos are not, there's no, yes, we automate or we use technology to our advantage, but there are human beings, okay? If you come to my office, you will see over 50 employees working. Okay, like there are people behind this. Okay, and as a matter of fact, again, we're just leveraging the technology to provide a better experience. So what is that? Again, basically, we give advisors and clients the ability to basically use a digital wealth platform. So whereas in the past, you may have gone to a branch or gone to your advisor and had to fill out a whole bunch of stuff on paper,
a lot of paperwork,
signatures, right? You have to actually take a
paperwork.
pen and sign stuff. That doesn't happen in our platform. Everything that we do is done digitally. So the paperwork that we send you to sign is done digitally through DocuSign, and everything that you do through the process is done digitally. And that's including entering, onboarding in terms of putting all that information into our platform, and then ultimately signing the paperwork and getting a portfolio. And obviously we give you access through a portal so you can look at your investments, keep up to date. And we also share that same information with your advisor so that they can do the proper planning. They can see what's going on, and they can manage, the relationship to the best of their ability. So Robo-Advisor, again, is simply a digital platform where you can go onto, you can put in your information, you can set up any type of account, RSP, TFSA, and then basically when you fill out the information, we create a custom ETF portfolio that is very low cost for you, the client. And that's basically what a Robo-Advisor is. Okay.
Got it. Should I go to the next slide?
Sure, go to the next. Yeah.
Okay.
So the only thing I would mention as well that I probably should note is that, the people who are managing your money at NestWealth are of the highest pedigree. So what I mean by that is that my portfolio managers that work at NestWealth have a CFA designation, same designation that most mutual fund managers or professional high net worth portfolio managers have. We are regulated by the same bodies, so there's no difference. We have the same fiduciary responsibility. The big difference, though, is that in order for oftentimes clients like yourselves potentially to access these high net worth, highly credible, highly experienced portfolio managers, you have to have a minimum of 500,000 minimum. And I would say typically that's probably more like $1 million. So the fact that you're able to access all of those, advisors and all those people that use our service at such a low cost is hugely powerful. Okay. So I think that's important. And again, we're only one piece of the puzzle. Okay. As much as we do build portfolios and these custom ETF portfolios for you, the client, we are just one piece of that. Letitia is going to make sure that all the other pieces of your financial picture are being looked after. And that's why, it's important to have an advisor, because we only cover a small piece of the overall financial picture. Really, the relationship, the advice, and all that still comes from Letitia, the advisor, in terms of making all these pieces work together. Okay.
Thanks, Neil. Did you want to, and I know you're gonna get into what an ETF is, because some of our audience may not be familiar with that term. And we already discussed where does the term robo-advisor come from. Now, one of the myths about this digital wealth platforms that people may have is that, is my money safe? I know that if I have my money at the RBC, I can walk into a branch and banks are regulated. So what can you tell us about, the safety of using a fully digital money management platform?
Yeah, absolutely. So, listen, again, I know we passed over, I think, the myth number one, which is, again, that whole robots thing. So I would just say, again, there are no robots. Every trade that we do is done by a human. And and we just give you a real simple, easy way to do it. But in terms of your money being safe, I think it's a great question, and it's a very important one to talk about, because as I mentioned, first of all, we are registered with the OSC, the Ontario Securities Commission. So we have the same fiduciary responsibility that any money manager has. So just because it's digital doesn't change the fact that we have, rules and regulations and regulators that are watching us, that we've been audited many times. We've had the regulators come in because we were the first robo-advisor in Canada. We were under great scrutiny. Matter of fact, I would say far more scrutiny than any other robo-advisors, because we were the first on the scene. So they took a great interest in what we were doing, and we had an open door policy. So we had nothing to hide. We want to be compliant. And I think that's an important thing to understand, is that Robo doesn't, this digital wealth doesn't mean that we're trying to circumvent rules or try to do things in an inappropriate, unconventional way. We are following the same regulations that everyone has to follow. But there's more. The other important thing that should give you great comfort is the fact that besides our, again, higher standards of interest, best interest, we also have all of our assets stored at a custodian. Now, again, I don't want to get too technical with you, but I just want you to understand that we have to do all of our work or all of the account openings on a separate entity. So we use a company called Fidelity Clearing Canada or a national bank. These are the people, these custodians are the ones that actually hold your accounts. So they are the ones that ultimately hold the assets and are responsible for those accounts. So God forbid, which I don't think is going to happen ever, NestWealth, goes bankrupt or no longer exists. Your money is completely safe because it's not held with NestWealth. It's actually held with a custodian that is huge, like a Fidelity or a national bank. So there is no concerns there. And I'd even go as far to say that because those assets are held with that custodian, there is the Canadian Investor Protection Fund. So these amounts are actually protected by the government under the Canadian Investor Protection Fund up to $1 million. So any of your balances up to $1 million are covered by the Canadian Investor Protection Fund if, God forbid, the custodian went under, which again would be impossible. It just doesn't. It's just the likelihood of that is it's like winning the lottery 15 times. It's just never going to happen.
And again, so just to be clear, the types of investments people have access to could be market-based investments, and nobody's telling you that, hey, if the market goes up, market goes down. Don't expect that unless you are invested in something that's absolutely guaranteed. Don't expect that that's going to be guaranteed. They're not guaranteed at the bank either. When you're investing in equity-based mutual funds, the same thing could happen. Money goes up and down. The performance of your fund could be up and down. What Neil is referring to as that insurance protection is in the unlikely scenario where one of the custodians were to go under. So again, we're dealing with National Bank. We're dealing with Fidelity. What was the name of the other one?
It's Fidelity, basically. Fidelity.
So, yeah. So just like banks are, bank deposits are insured by CDIC, which is again a government corporation up to a certain amount. These types of investment accounts are also protected against that unlikely scenario where one of the actual institutions were to go under. Okay, so that's something to keep in mind. And again, we are in Canada. This is a very regulated environment, so it's not like anybody could just go out and open one of these institutions with no oversight. Let's be realistic. So
yeah.
Okay.
So I'll pick up here. Yeah. So again, what we're trying to do is just dispel some of these myths. So another myth that is out there is this whole idea that robo-advisors are only for millennials or investors with small account sizes. Completely disagree. I've found, or at least at NestWealth, we have found that the majority of people who actually want to take advantages are the people that have money because they're the ones that stand the best chance of having a massive effect by lowering their cost of ownership, right? So, yes, we have this belief that millennials are great at technology, but if I trust me, if you were to see or go through my onboarding experience, I can guarantee you that even at 60 years old, 70 years old, it is a breeze. Like the simplicity of how we do it, you don't have to be a millennial to do this, okay? And I would even say that if you look at most of the Google stats or Facebook stats or YouTube and stuff, the people who are actually spending the most time on internet and doing things digitally are actually people that are in retirement or the older generation. Most millennials are actually working and don't have enough time during the day to spend. So the heaviest users of technology, as far as I'm concerned, are the older generation. So that's, I think, a myth that people don't really understand, but that's the reality if you look at the stats. And so it's no different here. The older generation has way more opportunity to take advantage of the savings that are implied in our product. And so, it's not surprising to me that they have the most to gain and that they're the one most interested. The other thing that you probably heard on the video that I think is really important and that you need to understand is that what the average client is. And at NestWealth, I think the video said more like, sort of 30, 100,000. Our experience at NestWealth is actually quite different. Our average client's 45 to 48 years old with 160, 170K in assets. So that's the type of individual that we are attracting. And again, it's because of the simplicity. It's because of the low cost. It's because of the digital platform and the fact that they still get to work with an advisor. It's all of those things combined that really make this impactful, right?
Now, that being said, yeah. Neil, if somebody's just starting out, they should know that there's actually there's no lower limit or what have you. In other words, somebody could really just start investing from wherever they're at, right? There's no minimum amount that your platform requires in order for people to even get started. So I don't want, just based on what you just shared, I don't want anybody in my audience to feel discouraged and feel like, oh, I need to be one of those people in order to even start using one of these platforms. Anybody could start, and perhaps we can get into some of those details a bit later, but you could even start with a small monthly deposit. You don't need to necessarily have something already saved up. Although, of course, if you're currently having money sitting in mutual funds, hopefully during this presentation, you'll understand why it may be in your advantage to consider something like NestWealth, okay? We already spoke about that. Oh yeah, okay. Do you wanna cover this?
Well, yeah, I mean, again, I think the video did a good job as well in sort of showing how large this space is potentially becoming. Because, there's, what did it say, 70, 80 billion now, but there's 300 trillion of assets that are still, open to this type of a move. So I just would likely say that this is not a fad. And the two big things for me that I think are important for everyone to understand is, first of all, sometimes in the investment world, there are these massive events, almost like a tsunami, okay? And this happened back in I would say the 70s or early 80s, most people were invested in GICs. And then when the 90s came in, all of that money, because interest rates plummeted.
Interest rates were a lot different back then.
Exactly, right? Back in those days, people were getting 10, 15, 20% interest rates. There was no reason,
risk,
right? Exactly. No reason to take risk. But when interest rates started to slide considerably, mutual funds came onto the scene. So all that money that went into GICs floated back into mutual funds. I would say that same event or that same tsunami is happening now, where all the money in mutual funds is trickling, well, not trickling, actually flowing to ETFs. And so, if you look at any industry statistics, you will see this trend. Massive amounts of money moving from mutual funds to ETFs. And because of, I'm not going to get into too much detail, because certain advisors are licensed in certain ways and whatever the case may be, the robo space or NestWealth is probably the easiest, best, simplest way for most advisors to access ETFs.
I agree.
And so there is this
conversation.
And so there's this marriage. There's this wonderful thing that's happening right now where advisors are taking advantage again of the technology of the robo space to gain access to not only the ETFs but this whole digital platform and sort of professional money management. So I wanted to mention that because I think it's important about understanding this whole shift of mutual funds to ETFs.
Now, I just want to mention, Neil, I know some people in my audience are very heavy into real estate and they like to invest their RSPs and TFSAs in mortgages. We will talk about that on a different call. What I'd like to open your mind up to today is that, especially for those of you whose money is currently held in mutual funds at a bank, I want you to know that there are lower cost, more efficient, and in many ways better alternatives out there. So that's what this conversation is about. Those of you who like investing in mortgages and other types of real estate type investments, I'm not discouraging you from doing that. That being said, there's something to be said about diversification, and Neil will also talk about that in a few.
And the other thing I just want to mention as well in terms of the fad part of this is that you also know when things are maybe a fad or not by who gets involved. So I would just tell you that most of my competitors have been bought out. So and that's because, first of all, banks are typically built on legacy systems, so it takes them quite a while to figure things out. Same with insurance companies. And so it's easier for them to go out and buy a robo and ingest it into their operation or their business than it is to create it on their own. So the fact that all of my competitors are being bought out by the likes of CI or PowerCore or Industrial Alliance, Guardian, like it is amazing the amount of activity of large financial institutions in Canada that are securing a robo platform to really bring them to the future. So to me, that says a lot. The other stat I'm going to mention here that I collected is Canadian robos will hold an estimated 8.1 billion in assets under management in 2020, which it predicts will rise to 16.6 billion by 2023 for a 26.7 compound annual growth rate. That is unbelievable. To have an annual growth rate of 20 over 26% is just phenomenal. And that's what's happening in this space, right?
Yeah. Wow. This is it's part of the way of the future, guys, and that's why I wanted to bring your attention to these platforms.
Okay, so this is again probably one of the most important slides we'll talk about today, and I mentioned it right off the get-go, and that is that this myth that you have to choose between a robo and a traditional advisor. Not true. You can have both, and I would actually say you should have both. Okay, because the reality is that advisors bring value, and one of the studies, and you can. I didn't bring this, or I'm not showing you any slides. That I have a bunch of this stuff, and maybe we can look at this again at a different time. But there is a thing that you could look up even on your own called, and it's a research that was done by Vanguard, and it's called Advisor Alpha. And all I want you to understand about this Advisor Alpha research is the fact that it's been proven from a quantifiable way that advisors add typically 3% of added alpha or improved performance in terms of their wealth or their financial investment sort of experience. And that is again because advisors give the confidence for clients to enact. They give them the clarity and the comfort to move forward with purpose and conviction. And so we all know that sometimes investing can be shrouded in anxiety and sort of nervousness and that's why advisors I think are so important. And so the other important thing to understand here is that again, we're leveraging the parts of the process where advisors don't add value. Like, believe it or not, there are parts of the process that technology should use and advisors shouldn't do, right? Like, advisors need to spend their time on the relationship, on the advice, on the financial health and wealth, right? Like, sort of all of the things that make that up. They shouldn't be spending their time on paperwork. That is really not a value add type of experience. Same thing on rebalancing. If you think of the amount of time and effort that certain advisors, and it's not because they want to, it's because the regulators or the structures that exist in Canada force them to spend time in areas that they should not spend time. Okay. And that's the thing I love about a robo-advisor is that we're going to take back a lot of those things that advisors shouldn't focus on, which is portfolio construction. Leave that to the experts. Again, I have high quality portfolio managers with CFA designations. No offense to Letitia. They are way smarter, way better, way more experienced, have way more knowledge about the markets and everything than any advisor will ever have.
No, okay. And what I'd like to say, Neil, is, in my own experience, like what's actually prevented me from getting more involved in the investment side of the business is the amount of paperwork we previously had to deal with. Now, thankfully, and as a licensed insurance advisor, I also have access to a certain type of investment vehicles out there, primarily segregated funds. Now, as you well know, they come with pretty high fees, and that's one of the disadvantages. They do have certain advantages for certain clients. They are appropriate for certain clients. But what's always discouraged me from the investment side of the business has been this, the amount of paperwork involved. And that paperwork is because of regulations and compliance. And I'm aware of that. Now, having that all done seamlessly on a digital platform makes my life easier, makes our clients' lives easier. And at the same time, maintains that compliance required by the regulators. So I see it as a win-win. I see it as a move in the right direction. And unfortunately, not all the insurance companies, as you said, the financial industry is one of those behemoths that is not so easy to change. And yes, some insurance companies have moved on to digital platforms. Some are still largely paper-based and still moving in that direction. So I'd rather go where the future is going, which is towards seamless digital integration,
So two other quick things.
Yep.
One thing I would say is that, I think clients, when they do it alone, I think there's a lot of risk. And that only because oftentimes, even on our platform, you have to go what's called a risk tolerance or a KYC, so that basically we can assess your situation and get information on you and understand sort of your thoughts about the market and your risk tolerance levels and all those things. And those things are pretty important because the way you answer those questions has a dramatic effect in the type of portfolio that you get. And if you're not working with an advisor who's sort of helping you through that, that can be challenging and a very difficult sort of situation. And that's, again, it just highlights the importance of having an advisor as working in tandem with a solution like ours, because again, it just adds to the overall results of what's going on. And I'll just quote something here because I think it's important. And it says, a Capital One survey found that 69% of investors would like to use a digital human hybrid to manage their money, while 74% say they want a financial advisor to help them get through the turbulent markets. So again, I don't know how many of you had this situation, but if you were a do-it-yourselfer and you just went through the 30% market correction that we just went through because of the pandemic, and you sold your investments, you have done irreparable damage to your portfolio. I hate to say it, but if you cashed out and you didn't get back, and waited until the market rebounded pretty well to where it is, to back to the 30% it's already got pretty well given back to clients. If you were sitting on the sidelines, you have done irreparable damage to your accounts or your wealth. So if you had an advisor that talked you off the ledge and said, don't do this, do not sell your investments, it is the worst mistake you could possibly fathom. That behavioral coaching is worth thousands and thousands and thousands of dollars over your lifetime, tens of thousands of dollars.
Yeah, we spoke about this in our first things, Neil. We spoke about this in our first webinar, the financial planning basics one, in which history shows everybody wants to buy low, sell high.
Yeah.
Unfortunately, emotions tend to get the best of people,
exactly.
And unfortunately, my own parents did exactly as you'd expect. As soon as they saw the market crashing, they went to cash, they went to JCs, what have you. And this is you're just actualizing your losses. So, absolutely. So myself and colleagues of mine, especially those that have been very much investment focused for their clients, they're there to I have one of my colleagues said, oh, my clients are well trained. They don't and again, you got to keep in mind, what's your investment horizon, what are your goals, and if you're going to be reacting emotionally at the first market correction, in time your results are likely for sure going to be lower in terms of your net returns over time. Do you want to talk a little bit about what ETFs are and
Absolutely. So now we're sort of switching gears a little bit, and we are sort of now going to move more to the sort of the actual strategies or the ETFs and how we use them and sort of that type of stuff. So the first point, I guess, is this whole idea about passive versus active investing. So again, a lot of robo platforms utilize passive investing strategies, and I think we do this for a bunch of reasons. First of all, and listen, I'm not here to cast shadows on active investing. That's not what I'm here to do. I think active investing has a place, but I will sort of yell from the treetops that for most Canadians, the core of their portfolio, as far as I'm concerned, is far better served using a low cost vehicle to do that. Most active managers don't outperform their benchmarks. It's just a fact. And so you're really sort of paying for performance that you're not necessarily getting. And so that can be a problem. I think we all realize it is very hard to predict the future. And as much as sometimes, portfolio managers get it right, it is very difficult to do this on a very consistent basis. And so as a result of that, we don't try to beat the market. That is not what we do. We buy the market we build a diversified portfolio, and then we rebalance when the market goes out of whack to take advantage of those sort of anomalies. What a typical active manager does is they just try to buy a small sort of concentrated portfolio and really try to beat the market. And again, oftentimes there's much higher fees as a result of that. Mutual funds are very expensive comparatively, and especially seg funds. It's just a very hard thing to get done consistently. So
this is a very poignant slide here, Neil. I've always heard it said that less than 5% of mutual funds beat the index, beat the market. So it's almost a fruitless pursuit. If your chance of outperforming certain market indexes are less than 5%, what are you paying for? Are you really going to be in the 2% of Canadians or of investors that picks the winner? And I remember in the newspapers back in the old days, they had a list of mutual funds and how well every one of them had done, and this is this month's winner, and then we had this is this week's winner. But at the end of the day, over a long time, we know that a very, very small amount of mutual funds, and in this case, ETFs. Now, do you want to talk a little bit about what the difference between a mutual fund and an ETF is, in case people are wondering? It's a bit of a
for sure. And I think that's the next slide.
Okay, fantastic.
So, but just before I go into that, I just want to mention too that I don't want to get too technical, but I would just say mutual fund managers often have restrictions as well, right? So the larger the fund is, the more they become a closet index. So what you're really buying actually is more like an index than sort of an actively managed portfolio. And that's just, again, because of some of the restrictions that they have to follow. Plus, a lot of times mutual fund managers have to be fully vested. So again, they can't really time, their mandate says that they have to be fully invested. So they can't necessarily do certain things to prevent, oftentimes, a significant downturn when markets do turn on them. So in any case, it's a very difficult science to do. And the reality is that passive investing does make a lot more sense for the core of your portfolio over the long term. Again, I'm not saying that, there are certain things, asset classes that I think, you can be speculative with and you can add to your portfolio, but the core of it, it makes a lot of sense to have that in what we're talking about. So what is an ETF and what is a mutual fund? It's interesting because they're similar, but they're not. So an ETF is something that is traded on an exchange. Okay. So I want you to understand that an ETF has a ticker, like a stock ticker symbol. Okay. So, but the thing is, it doesn't invest in one stock. Okay. So even though every stock has a ticker or a symbol or, like an identifier, an ETF has one sort of ticker, one symbol, one identifier, but it is comprised of hundreds of different stocks, much like a mutual fund. So the similarity between a mutual fund and an ETF is the fact that it holds a basket of securities. There is a portfolio manager that is deciding what sectors, what securities, what to invest in. And that is being sort of, there's a bundle of different securities that make up a mutual fund. Same thing with an ETF. Now, again, typically in the mutual fund, there's the manager that's really doing a lot of that lifting, or in terms of stock analysis, in terms of the company and the sectors. Whereas again, with ETFs, it's more of a passive, although there are active ETFs that do more of that, we take more of a passive approach. So we don't necessarily control, or we work with great providers like Vanguard, BlackRock, iShares, some of the largest money managers in the world. And they're the ones that really pick the index and that's what we're buying. We're buying an index. So we're not actively managing those securities underneath the portfolio. We're buying an index. We're buying a bunch of different indexes to create a diversified portfolio. But each one is comprised of hundreds of different individual stocks of the top, that represent that index or represent the top companies in that specific area or sector or geography. So does that make sense, Letitia? Like, did that really sort of help people understand, you think, what the difference is?
Yeah, I mean, if you want to think about it, an ETF is like a low cost mutual fund, and we're not attempting to, there's, much less of an attempt at active management. We're buying certain market index, and we'll have an example of that in the next few slides. But I think this slide also shows exactly what you were talking about earlier, Neil. I think people have figured out that, the time for mutual funds is largely over, and people are tired of overpaying for bad performance. Really, like, what are we paying for? And so the opportunity is to essentially move into these types of investments that are much lower cost, and where you can literally maximize your returns.
Yeah, and again, I don't know if I would say it's bad performance. It's more relative performance. Like, again, to me it's about,
Sure.
You always want to pay fees based on the amount of risk you're willing to take, or and so it's always this balance, and I would just say that I think a lot of times just active managers aren't necessarily giving you that good balance, right? You're getting charged a lot, but you're getting relative performance where you really should be getting outperformance because of what you're paying, right? Because if I'm able to build a similar portfolio to a mutual fund portfolio and give you the same performance, but again, have the way less cost structure, again, it's just that's the problem, is that the active managers aren't necessarily they're not giving you that extra performance. They're giving you sort of the same performance as what an ETF gives you. But again, you're paying a much higher cost for that, right?
And we spoke about that. And so again, we're talking about billions going now into the ETF market.
I think the other thing too you should realize is that, how do I say this in a nice way? I mean, you just got to be careful in the sense that oftentimes, you may be put into an investment that serves, I don't want to say the advisor more, but serves maybe the institution or where you're buying it more. So for example, when we construct portfolios at NestWealth, we don't have any proprietary ETFs. If you look at the ETFs that are here, these are all ETFs. So we basically scour the universe. We look at all the ETFs that are available in Canada or the US, and we try to find the best money managers with the best reputation, the most liquid, just the best in class in terms of money managers in the world, and which are Vanguard, BlackRock, iShares, BMO. These are large sort of, great financial investment companies. And so we use their products. We don't invent our own just to pad our pocketbooks. We find the best in class with the lowest price, cost for you, the client, and put together the best diversified portfolio we can that is not correlated. That's really representative of the most diverse portfolio we can create. And again, we use third parties. Whereas, oftentimes if you go to a bank branch, for example, you're only going to get the bank's products in your, so they restrict the universe of what you're buying so that you can only buy their product. So it's essentially like double dipping. They're
money
getting,
for them. Yeah.
And so I just caution you that, that's the other thing I think about robo platforms is that oftentimes, we're not being bound, or we're not using that type of mentality of padding our own sort of, products. Some do, but we tend to sort of shy away from that and really just look for the best products and the best, diversified portfolios we can build at the lowest cost so that clients get the advantage.
Yeah. I don't know if you want to talk about
this. I do want to talk to this. And again, this is not to confuse you, but I think it's important because I think a lot of people maybe have seen this chart. And again, I don't need you to focus on what it's saying or the specifics. The key thing I want you to focus on, hopefully none of you are colorblind, because that's the important part here is the colors. And all I'm trying to show you in this chart, if you look at the colors, is to show you that, the ones at the top were the best performers and the ones at the bottom are the worst performers. And the point being is that you could look at any one year, look at that color, and then look at the next year, and you could see that, the one year it was at the top, and then the next year it was at the bottom, right? Yeah. And it's just going to this point again that this is a very, very hard thing to call. Okay. It is very difficult for even the best managers in the world to figure out which sector, which stock is going to be the rising star, or which one's going to get pummeled as a result of, what's happening in the market. So, and that's why it's so important to have a diversified portfolio. So that's what we do at NestWealth. What we help advisors with, because it's been proven, is that as long as you have a diversified portfolio, let us do all that work. Let us figure out what that looks like, where it is on the efficient frontier, what the best products are, and let us put together a well-diversified portfolio that's going to sort of work well in all types of markets over the long term. And that's the important thing. So I just thought this really does put into perspective the fact of how difficult it is for money managers to really pick the right sector or the right stock.
Yeah, literally, it's different from one year to the next. It's different from one year to the next, and that's why we want to be diversified. And then, so tell us about the strategy that NestWealth uses.
And this will be my sort of last slide. So then we can open it up for questions and maybe get some thoughts, or you can ask me some questions, Letitia, and I'm happy to answer them if you have any that you would like me to expand on. Sure. But listen, we didn't come up with our own investing, as a robo, we didn't come up with our own investment, philosophy or we were using a Nobel Prize winning strategy, which is modern portfolio theory. So, this is a well-known theory studied in universities and used in the market today. Okay. So Harry Markowitz in the 1950s basically created modern portfolio theory. And so, we're using that theory, and then we're using basically David Swenson, who is a proponent of that theory, and using his specific sort of what they call the Yale endowment sort of model in terms of the modern portfolio theories. So it comes with three main tenets. First of all, is that the investors should maintain a portfolio allocated to 6 core asset classes. So that's what we do. We have global equity, US equity, Canadian equity, and real estate. Okay, so we make sure, and then of course there's a fixed income component to that as well. But the point is that from an equity standpoint, we want to make sure that you have exposure in the US. And the reason why we almost overweight US is because it's the most broad, diversified marketplace in the world. It's got the most sectors with the largest companies you could possibly fathom. So so US is huge, and then also Canadians typically have a Canadian bias. Any country that you live in, you typically have a bias towards your own securities. It's just how it is. And so we actually minimize that bias by having a less allocation towards your Canadian equity. And then of course, oftentimes people don't have enough global. So, we make sure that there's a decent amount of global exposure so that don't have all your eggs in one basket, right? Because that's the worst thing you can do. So, well diversified, again, emerging markets, international, government, fixed income, very diversified portfolio. Point number 2, investors should rebalance the portfolio on a regular basis. Again, the wonderful thing about the Robo-Advisors, or what we do at NestWealth, is that we've automated that to a large degree. So, what typically an advisor would have to spend, oh my God, weeks, months talking to each client, rebalancing their portfolio, getting them to sign stuff. I mean, that is a massive undertaking unto itself. Okay. The fact that we sort of 24/7 are constantly looking at every account in our system and looking for opportunities to take any one of those accounts and rebalance it based on, their allocation and their structure is amazing, right? Like we're doing that 24/7. We are constantly looking at every account in our system and looking for opportunities to rebalance that account to make clients whole back to their target allocation and make the money and give them a better sort of opportunity to make money and to grow their assets. So that's huge. That's a huge
I don't know if you want to explain even what rebalancing is, because we did talk about the fact that we are employing primarily a passive investment strategy. So now you're talking about rebalancing. It almost sounds like,
and that's that's a great question, a good point, Letitia, and I should explain that because I think again there's this myth that passive means we do nothing, right? Like we just sort of buy an ETF or buy an index and we just sit on it. And do absolutely nothing. And I would say that's not the case. There is as much as I've talked about active management, there's an active, what I call overlay in what we in the strategy that we do. And that's the rebalancing. So that when a client comes to NestWealth, we give them a target allocation. So we basically determine what percentage of allocation we're going to allocate to each one of these core asset classes. And then what happens is, as markets go up and down, that allocation gets off its target mix, right? So, you know, you may end up having, you may have started with, let's say, 50% equity, but if the markets are tearing up and things are great, you may end up having, that equity component may end up being 70% of your portfolio. So what we do is we take the profit of whatever that growth is, let's say, of the asset that's really done really well. So we almost like realize that gain and then add it to the area of the portfolio that is not doing nearly as well. But again, what happens likely is that portfolio, that's the part that actually picks up in maybe that different cycle or that different, right, and gets you back to the target mix of what you're supposed to have. So there's a fiduciary responsibility around that, to making sure that, you know, when portfolios are changing based on markets, that we're rebalancing them back to the target weight of what they should be, because we have to comply with risk and, you know, what the KYC or the risk tolerance mandates are for each client. And so there's a responsibility for us to do that. But that's what rebalancing is essentially. It's that whole process of getting back to your target mix that was established when you opened up the account, and again, realizing gains and adding, is sort of like, taking from the winners, adding to the losers, and sort of constantly rebalancing that portfolio to its proper mix. And that overall tends to be a very good strategy. So again, even our equity portfolios, which again experienced some pain during the downturn recently with the pandemic. I mean, because we were rebalancing even before that, you know, it helped us. So, you know, our relative performance has actually been pretty good. And most clients have actually done very well comparatively to active managers in terms of the downside, is never mind the upside. So, that's proven to be a very important strategy, and one that I think, again, advisors don't typically do that well because it takes so long to do and it's a painstaking process. Typically, most clients get rebalanced when they come in for their meeting once a year or twice a year, however, right? So, you know, the fact that we're doing this every day, constantly looking for opportunities to rebalance and get clients back to their asset mix is huge. And then the third thing, that's obviously as important as the other two, is the fact that, you know, that you use low cost products. Because again, that's really where the crux of this comes. Because again, just imagine, folks, if you are buying a mutual fund at 2.5%, I mean, this is simple math.
Should we go to the last example that you have for us, Neil?
Sure.
The case study. So I don't know if you. No,
just go to the next. Like, just go next one. Go to this one. So this is because again, the point here is that, you know, when you have a mutual fund that is 2.5 to 2.3, whatever percentage it is, let's say over 2%, okay, and you're able to, you know, get a much cheaper, you know, alternative product for 1% or way less than that, you know, that money now is staying in your account. It is compounding. It is growing. So the more money that you can keep in your account and not lose to fees, that you're over the long term, you're constantly getting compounding, getting that money is building much quicker, because again, it's not being eroded through fees. And so this is the type of result you can expect, is that, you know, with just the savings in terms of mutual fund versus ETFs, your nest egg is dramatically different at the end of the road over 25 years. You actually stand to gain a significant, and that's again, just by buying a product that is less expensive. You're not sacrificing necessarily return. You're not sacrificing, you know, anything in terms of risk, reward. Like, all you're doing is you're replacing what you're using as the product, which is potentially a mutual fund, and buying another product that gives you a very similar experience, but for way less cost. And that cost differential is the difference between having, again, 667,000 versus 993. Right?
Yeah, and I mean, this is a cute slide. You know, imagine the possibilities with that extra money. Of course, it could add up to a lot in time. So, and I think this is now, Yeah. So I mean, all of these goals can be accomplished using the NestWealth platform. And Neil, as an advisor with Hub Financial, we have a relationship with your company, and I will post under the video. I will post our referral link. So essentially, I can remain your advisor. If you need help, even with the onboarding process, that's my job to help you with that. You could go ahead and go through the process yourself. But if you need any hand holding with that, it would be my pleasure to help you. Now, Neil, sorry,
Yes.
did you want to say anything?
No, that was it. I think that was my presentation. That's really the main points that I wanted to get across. I hope everyone found that useful and learned something, because, you know, this is about learning. This is about understanding. And I think we did I'm happy with what we did, Letitia. I think people hopefully have a really newfound understanding of what's happening currently in the markets, and just, you know, the changes of products, and just, you know, and the ability for them to potentially take advantage of this type of a solution that will help them over the long term.
So we have a question here.
Sure.
Do advisors, human or robot, provide better returns than directly investing in index funds? Okay.
Well, no, I mean, how do I say this? If someone wants to do it themselves, that is no question the cheapest way to go. Okay. But again, there are inherent risks with that type of an approach. So, you know, yes, you can go to a discount broker. You could buy, you know, ETFs on your own. But again, what happens when, you know, one of the ETFs fails you miserably, right? Like, what are you going to do in that situation? Again, advisors are going to help you, right? They're going to walk you off the ledge. They may, you know, like there's no advice in those platforms.
One second, Neil, because I have to stop sharing the computer sound because there's a bit of a delay with.
Oh.
1 second. Yeah. Give me 1 second. Stop. Yeah. I don't know how to.
Well, it sounds, I mean, I'm not hearing a lag. Are you still
You're not hearing it? Yeah, no, what happens is I was trying to answer the question. Okay. We may have to, no, I appreciate you answering the question, Neil. So again, what statistics have shown is that clients that work with an advisor over time do have higher net worths.
Yeah, that was again, I thought I'd go with first of all, you know, the reality is, again, the cheapest, if you were looking just pure for the cheapest, then yes, you go to a discount broker, you get no advice, you buy ETFs that you think you want to buy with no advice. And again, you're alone, right? You're not paying for anything. There's no advice. There's no one there. You're on your own. Okay.
Yeah.
What I would say, I disagree with that. I don't think that makes a lot of sense, because again, it has been proven, like Letitia says, that working with an advisor can add alpha, and I've seen good advisors like Letitia, and I see the value that they provide, because to me, it's not just the wealth side of the conversation. It's the insurance,
that's right,
it's the risk, it's the budgeting, it's the, like, if you look at all the things that a financial CF, you know, like an advisor does, you know, it's just, there's so much more that is added to that equation that is of value, that I think is worth paying for, because I think, again, it's something that over the long term, you get a lot more value out of. And again, I do fear incredibly for those do-it-yourselfers, because we've seen that. If you look at the stats of just the recent pandemic and do-it-yourselfers, they are the ones that we got the most calls from, even at NestWealth, because there is a direct channel. And, you know, those are the people that we had to talk off the ledge, right? And right, because they didn't have anyone else to turn to. and often, and I can tell you, a lot of those people made terrible mistakes. They did irreparable damage to their portfolios because they wouldn't listen. They thought they could do it themselves.
Got it.
And it's proven that when these things happen, when market corrections happen, they're the first ones to cause the most damage to their portfolios because it's emotional. They're alone. They're on their own. There's no one talking them off the ledge.
Yeah, no, thanks for making that clear, Neil. And again, people who choose to invest on their own and they have the confidence to do it, I'm not going to tell them not to do it. Of course, we just know that statistically, people that work with an advisor over time, they have higher net worths, and it's what you said. Then again, colleagues of mine have told me, my clients are well trained. They're not going to make these emotional decisions. They're going to stick to, okay, what are your goals? Exactly. What is your time horizon? And then again, with the help of a firm such as yours, you already talked about the value of rebalancing. Anyway, everyone, I will post below the link. Should you be interested in exploring switching over to NestWealth from, if you're currently in mutual funds and you're thinking, okay, I don't want to pay this high fees anymore. I want to look at other options. I will be happy to help you with that process. I'll post the link. And if you have any questions, you can reach out to me directly, okay? Thanks again, Neil, for joining me today.
My pleasure.
And enlightening us with your expertise. And I look forward to staying in touch and continuing to collaborate. Awesome. So with that said, bye everyone on Facebook. Let's say bye. And I will stop the stream now. Let me see how I do that. Okay, and oh, how do I, okay, I have to